Welcome to the Vision Creator Podcast, from corporate to creator, with your hosts, Pamela Martino and Debbie Williams.
Hello, all. Welcome to the Vision Creator Podcast. I am Pamela Martino, along with my co-host, Debbie Williams. We have an amazing show for you today. If you're in the market to buy a home, refinance, purchase an investment property, or maybe even considering a second or a destination home, you absolutely want to tune in. We have two residential lending experts in today to answer all things related to purchasing a home. They are here to help you understand and navigate from start to finish the process of getting a home mortgage. Without further ado, please welcome Keena Gehringer from Grand Line Lending and Stanley P Wade from North Point. Great to have you both on. Thank you so much.
Thank you, Pamela. Thanks for having me on.
Yes, thank you for having us. Absolutely. So we have a lot of information to discuss. So we're going to just cut to the chase and jump right in. And Keena, the first question is for you. And let's get started. Let me just go back and say, by the way, I am a real estate agent for those being the first time tuning in. Debbie is also in the real estate business as well. I'm located in Charlotte, North Carolina, and I've worked with both Stanley and Keena over the years. I've been in real estate since 2008. Wonderful, amazing people, very knowledgeable. That's why they're here. They're our experts. And so the intent is to go through the home buying process from start to finish. So those that are in the market, they'll be able to walk away from this podcast and know what they have to do to get started. And Stanley and Keena are both available to help guide you guys through this process. So let's get started. Keena, let's talk about the different type of loan products, right? You hear out in the industry, FHA, VA, conventional, first-time home buyer programs. You know, the calls that I get that for first-time home buyers, people are interested in, are there down payment assistance program? What are the first-time buyer home products out there? Let's talk through that and see, what information you can share with our listeners.
Yeah, of course. Well, there's always a robust amount of options whenever you are looking at lending and purchasing a home, whether you're a first time home buyer, it's your second time or third time investor. There are so many options out there. Your general option that most people already know of is a standard conventional loan. Conventional, it's a great option for a lot of my home buyers that may have a stronger credit profile. They may have some money in the bank. They're prepared to bring their own funds for a down payment and closing cost. But the great thing that a lot of people don't know about conventional, you do not have to put down 20% to use a conventional loan option. A lot of the times with conventional loans, people just think I have to put down 20%, but there is an option where you can put down as low as 3% if you're a first time home buyer on a conventional loan. There are some options out there where you may be able to put down 1% if you're a first time home buyer. So just keep that in mind. Conventional loans are great options for many borrowers, not just the ones that may have a lower amount of funds to bring on their own for their down payment. Conventional loans, the standard requirements are you would need to have, um, well, things are changing, guys. I was going to say at least a 640 credit score, but actually one of my lenders just announced this morning they are going down to 600 now on credit score requirements for conventional loans. Yeah. So there's a lot is changing. So as you are looking at options when it comes to lending products, make sure you connect with your lender and ask them specifics as far as what their company requires for a conventional loan, since that is changing. But conventional is typically a little more conservative whenever it comes to your credit profile. So that's why a lot of times people think that conventional loans are a little more strict whenever you're comparing conventional to some other options out there. It's not necessarily that conventional loans are strict, but they're not going to be insured by the government like your FHA loan or your USDA. So anyhow, conventional is a great option. Then you have your FHA loan, which is insured by the government. FHA is great, guys, for a lot of my first-time home buyers because it allows a little more flexibility when it comes to your credit profile and when it comes to even your debt to income ratio. Whenever I look at options between conventional and my government-backed options like your FHA loans, yes, conventional, again, I'm going to go back to that conservative word. It does require that your debt to your debt to income ratio depending on your credit profile, but typically it does need to be below 50%. Whereas on your FHA, your debt to income ratio can go a little bit higher on that back end. So a lot of my clients that have higher debts, they may have a few more blemishes on their credit profile, maybe a lower credit score. FHA could be the best option for them compared to conventional because they could be saving money on a monthly basis, especially if they're not putting down 20%. Because you'll have something, if you're not putting down 20%, called mortgage insurance. So on FHA, there's mortgage insurance. Conventional, it's called private mortgage insurance. But sometimes when you look at those two options and compare apples to apples, you may find that the FHA option could give you a lower monthly payment compared to conventional based on the mortgage insurance differences. In interest rate. Typically on your FHA loans, the interest rate are a bit higher, or I'm sorry, a bit lower. The interest rates are a bit lower. Again, the mortgage insurance, depending on the person's credit profile, that can be lower compared to conventional. And the down payment requirement is only 3.5%. So not everyone would qualify for the 3% down option on a conventional mortgage, but FHA, that's the standard, 3.5%. So again, FHA is a great product because it allows more home buyers to enter the buying world because they're able to be a little more flexible to help people qualify for homes, which is great since it's insured by the government. Any questions so far? I feel like I'm talking a lot. You can let me know.
That was really good information. And so let me just ask this. So because most people associate a conventional loan with 20% down. So
Yep.
if you don't put down the 20% will help negate the insurance, the
Yep,
PMI,
exactly.
right? So even though you still go with a conventional loan and you do less than 20%, you'll still have that private mortgage insurance. Is that correct?
Exactly. There are options to either buy out the mortgage insurance if that makes sense. Often, I haven't really seen a scenario where it does, but there's options where you could potentially still not apply private mortgage insurance to your monthly payment on conventional. But that goes down into another rabbit hole. So,
And just before we move off of the subject of the types of loan, let's not forget about our VA.
oh, we have, yes, yes. And I'm going to go over that too. So, now, VA is my favorite loan type. It's for our veterans out there. It is a fabulous loan product. So if you are a veteran, please reach out about your VA loan. Make sure if you have those benefits, you know exactly where you stand. The VA loan allows veterans to not bring anything down. So 100% financing does mean that there's no down payment, and that's your VA loan. But just remember, there could be closing costs involved with the loans. My favorite thing, though, about the VA loan, it is so flexible. So the VA loan is the only loan type that actually does not necessarily have a a threshold when it comes to your debt ratio, right? So we go off of something called a desktop underwriting system that audits all of our loans to tell us if we can get this client approved or not and what the stipulations may be throughout the process. But anyhow, the VA literally just goes off of that particular system on approvals. Most of my lenders, not everyone's made the same, but most of my lenders will go ahead and they will just go off the desktop underwriter and whatever that says for that client. If it says they can get approved and their debt to income ratio is at 60%, then they'll run it. So it just goes off of that. Yeah. So it just depends on who you're working with. There are some lenders that have their own guidelines when it comes to VA loans, but VA loans is awesome because there are so many options. It just allows more borrowers to take advantage of purchasing a home when you're a veteran. And also whenever you're looking at your interest rates on VA loans, they are super because most of the time your VA loan interest rates are going to be significantly lower than your conventional loan. So you have that and you won't have mortgage insurance on the VA loan. So even if you're not putting any of your own funds into the down payment, when you're comparing apples to apples, looking at a VA product in the mortgage payment versus FHA or conventional, that payment is always going to be lower because you won't have that mortgage insurance if you're not putting anything down. That's awesome, right?
Yeah, that's awesome. Yes, yeah. Is there anything you're seeing?
Yeah, go ahead, Stanley.
No, I was going to say I agree with her 100%. VA financing. Love helping veterans. I'm working with one as we speak right now, and so
Yeah.
it is a phenomenal product. And I actually approved a VA loan for $1.5 million about a year or so ago. Um, and again, 100% financing. So yeah, it's a great product. Recommend it immensely. Yes.
That's good. Debbie, you have anything, a question before? Because I want to say something to that of Stanley and Keena about thresholds. So I was going to ask, so with a VA, is there a minimum or a maximum amount that you can qualify for? And the same for any of the products. And I know everything's pretty much based on income, but I don't think you can use an FHA loan to buy like a $3 million product or $3 million house. I'm sorry.
That that's if I could jump in again.
Yeah, go ahead.
So yes, um, state by state, the new guidelines just recently came out that basically says that for a single family resident, this is going to be the maximum amount for, and then California, New York, I think Florida, New Jersey. DC are considered high cost areas. And so they will allow for a single family to be a larger loan amount. But traditionally today, if I'm not mistaken, conventional, we like it's like I thought I saw FHM was like 435 or something like that. It may be recently changing. Every December they'll come up with new numbers. So
Yep.
for 1 unit it's going to be this number, 2 units going to be that, 3 units is going to be this, 4 units is going to be that. So those numbers change based on what you're purchasing. But no, you can't buy a $3 million house using an FHA loan. Folks would love that idea, but no. But I will say that if I'm not mistaken, yesterday we got the changes. Conventional loans going up to $832,000 now is the conventional. So I read the number for a client who came to see me about uh purchasing about 900,000. Believe it or not, with 10% down, his 832 loan is like a conventional loan. So I says, yep. Now, I know some folks might say that's pricing me out, but from a qualifying standpoint today, he's considered a conforming loan up to $832,000 a day. So,
Wow.
yeah.
Can an investor tap into any of these type of loans, or they're because most investors, they're self-employed, and some may be asset rich but cash poor, so they may not have a lot of cash, and some may not even have great credit. So would an investor be able to participate in any of these loan products?
I'm going to say yes, and Kenny, you go ahead and jump in.
Yes, yes. Especially with the conventional, that's going to be your standard investor friendly option. Even FHA. So FHA is for primary purchase. You are planning on living in that home. However, hacking, your word that you mentioned, Pamela, you are purchasing a multi-unit. Let's say you're getting a duplex. You plan on living on one side, you could still utilize the FHA loan with purchasing that property with two different units, even if you're only living on one side. So what does that mean for you? 3.5% down, right? Lower interest rate, potentially a lower payment compared to a conventional option, depending on what that looks like for you. So you can take advantage using an FHA loan if you are purchasing an investment. And then with VA is for primary residence as well. And then it gets a little convoluted. But if you are purchasing outside of a primary, no, you're not necessarily able to use that VA loan, but there's ways that you can still go about, moving on to an additional property using a VA loan. But I think we should save that for a different day because that can get a little confusing. It's a little more.
I love what you just said about that multifamily and living on your outside. That's a new phenomenon, I would say, within the last 5 years, because prior to, right, I believe it was always 20% down. Anytime you use the investment, it was always 20% down. So someone can actually get a multifamily.
Yeah.
Is that more than just a duplex? Could it be a tri? As long as they get one to step.
As long as they live.
1 to 4 units. And if I can say, so FHA will allow you to buy a 1 to 4 unit with 3.5% down as a primary residence. And then the other 3 units. So that actually is your barrier if you're buying your first home to become an investor,
Right.
because you live there for a year, and a year later you can rent it out and then buy something else as your primary residence. You can't do that with FHA on the second time, but the first time you can do that. Conventional Freddie Mae is allowing you to buy 1 to 4 units with 5% down today. So you can also do that. So that's from Debbie to answer your question from a conventional standpoint, somebody buy. But from an investment standpoint, if you come in the door as an investor, you're going to let you put 20% down. And obviously, you're either going to go with your credit score, income. There are some stated incomes. You probably have heard the term lately, and I don't want to get too far in the weeds, but DSCR stands for debt service coverage ratio loans. Those loans allow for investors, and they're strictly using just the rental income, their credit, and their assets. No income is being considered at all. So those are widely available. We sell those all the time. So that is the option for an investor today. So two things, right? Primary person, owner occupied, second home, person buying the house at the beach or the mountains, and then the investor buying an investment property. So those are categories that folks will kind of be coming in the door with. So
And I'll add to that, just going outside of the box, just like Stanley was saying, the DSCR options, you have a whole slew of options when it comes to non-traditional loan types as well. That could also go in a different direction. But just know that there are so many different products out there now to get creative, whether you are looking to start investing, it's your first property or your second. There's so many creative ways to get you qualified, of course, that we can review to help you start your investing dreams, which is great.
That is going to help so many people because, the people that I come across and work with, they have, in the business and outside of the business, people want to get in, they want to start investing, but they think it's 20% down. And I think, isn't there like a rule, like if you live at least 70 miles away, like for a second home, then it's still only, is it 3% or 5%?
Temper. For if you're buying a second home, I
Yeah.
had a client living in Columbia, South Carolina, and buying in Charlotte. So he's more than 75 miles away. So they allowed it to be considered a second home, and he bought it with 10% down. So you can do that, but no, you can't. I don't. To my knowledge, there's no 3 or 5% down for
Okay.
second home financing. Yeah.
Okay.
Yeah.
Okay. And then Stanley, you said something else that was really good. So you said that you can only have one FHA loan to do multiple multifamily. So this is a good point to maybe segue. So if somebody wanted to refinance because they wanted to replicate that same thing that they did, they could refinance into a conventional product, right?
Yes.
And then go back to FHA and do the same thing. Can they do that?
They could. So the idea is, think about what we just said about the distance in miles. So let's use this as an example. My son bought a house in Atlanta and he did an FHA loan and he bought a 4-unit property with 3.5% down. No problem. A year later, he's got enough equity in it, he can refinance it and into a conventional loan. And then he wants to move to either another part of Atlanta or he wants to move to Charlotte. He can do an FHA loan with 3.5% down. The idea is that the distance is far enough apart in that regard. But if he were to refinance the conventional loan and go 2 miles away or 20 miles away, someone's going to say, hey, this guy is trying to use this to do, right? So it is the perception of the idea, right? So the optics because the underwriter's going to look at it and say, hey, it looks like he is running game on us, right? And so they will, I'm gonna tell you right now today there's a lot of great products, but there's also too savvy, smart underwriters looking at files to make sure that and I tell folks all the time, is it plain on the surface of it, right? If I look at it and say, is it 2 + 2 or is it 2 times 8? So if I have to interpret what it means, they will tend not to interpret it in our favor. So and lastly, I'll say this, right? Talking about, Keena mentioned the different various loan products. I tell folks that I've had the good fortune of been in the mortgage business for 37 years. I do mortgages for your life. Just like the nose is on your face is different from somebody else, so is your financial and credit picture. So when a consumer comes in to talk to me about mortgage financing, I'm going to ask the 3 questions and they never change. They haven't changed since we've been doing mortgage financing. Credit, income, down payment. Those 3 things determine where Keena's going to drive you into which product you're going to need because if you got a 720 credit score, she may have a very different conversation than one with a 620 credit score. Or she wants to buy a duplex in New York City. It might be very different than somebody buying in Charlotte, North Carolina. So those are the questions that I'm asking when someone comes in and says, hey, I want to get pre-qualified to buy a house. My friend bought a house around the corner and they did X, Y, and Z, and I want to do the same thing. And then we find out that the friend has a 750 credit score and they had a 560 credit score.
So you mentioned about if you are first time, I think you said you guys are first buyer as an or investor, right? You get in from the FHA. What if you're not? What if you're a seasoned investor, but just never purchased using FHA or none of the other products? You just did more or less conventional. You just used took equity out of your home and you just purchase a investment property the traditional way. You put your 20% or even 30% sometimes, depending on the type of property. But now you heard about all these great products that you and Keena just mentioned. It's like, oh wow, you mean to tell me I can go FHA and um and put 3% down for an investor property? How would that looked upon if somebody already has property, but they bought it the traditional way? Now they want to move over and do the low down, using some of the FHA products. How does
So David, I want to give a caveat, right? Kind of go back to what Tina said. FHA financing is not for investment. It is for owner occupied only. Now, you can buy a 4-unit property, but it has to be your owner occupied residence. It can't be investment. So now you can turn it into an investment property later, but how you start off is, so let's just say that you own a home today and you want to buy per se another investment property, then you're going to have to buy the next property as your owner occupied, and you can use FHA financing. So long as it makes sense. Let's say you live in a home that is worth $500,000, a single family residence, and 20 miles away is a 4-unit worth $750. You're going to move into the primary unit, you rent the other 3 units out. You can do that. But that's an owner-occupied transaction. So I don't want to get you confused with thinking that FHA is for investment purposes. No, I would tell a young person today buying their first home, if you can buy a multifamily property, I say that's a better route to go. As your primary, and rent the other 3 units out. And then a year later, you decide to move to an apartment. You can now rent the 4 units out, and that's your rental or your first investment property. That is a method to the madness, or the steps. But you come in and buy a 4-unit FHA, that's not an investment. You got to be on. Yeah, I will make sure we clear that up. Yeah.
Thank you for clearing that up. And then you also meant the DCR's debt service. And so in terms of debt to income ratio, how does that work? Either for an investor or non-investor relative to, well, if Keena touched on a bunch of them, but I guess from an investor standpoint, does that change in terms of debt? Well, it depends on the property, right? Again, I think you guys said that if you go investment property type, it's all based on how the property is performing, and how can it be paid back from the proceeds of the income, the gross income, right, or the net income.
Yeah. So, um, I'll just really quick see if I can answer your question for you. So a DSCR, that product was created for those investors, because you just kind of, I tell folks, think about this, right? The reason why the sign says you have to drive 15 miles an hour in a kid zone is because somebody hit somebody drive more than 15 miles an hour, right? So the reason why investment and DSR product was created, because they found a lot of investors are buying, didn't do the taxes yet, but they had cash and they had credit. So therefore, they kind of created a product, and the property was cash flowing. So the idea now today is that the normal rule of thumb is going to be 20%. That is the normal rule of thumb. So I do them all the time. I just did one in Indiana. The client buying a townhouse, the market rents would cover 80% of the mortgage payment. If it does, it cash flows. And all they're looking is him having the down payment and 6 months in reserves and the credit score. That credit score based on the pricing. We closed the transaction, no muss, no fuss, and he went on about his business. So that is how it's done from a DSCR investment windows. And we don't. And when you take the loan application, you don't need any income at all. I don't want anything. All I'm looking at is the rents, either the lease agreement or the market rents from the appraiser that says that this is the place will rent for, and that's pretty much it. And you can do that up to $1 million, 1 unit, 2 unit, 3 and 4. So long as it does, you're good to go. And
I love GSCR. Yeah. Based on the property. It's not based on the client as far as compensation, which is really nice. So again, it's another flexible option that is really helping investors capitalize in this market right now. It's great.
Yes.
I love that. So I didn't. So I'm familiar with DCSR. DCSR. Is that right? That or DSCR.
Yes.
So I'm familiar with it. And now that I know that I have 2 people that I trust, because I always felt like it was a lot of rhetoric over here. Like, I don't know who you're talking to fast. now that I have some more insight from people that I trust, that I could come to you guys and you'll steer me in the right direction. So that's
Yes,
Yep.
absolutely, absolutely.
okay. So let's talk about, and this is right now, it's a proposed type of thing that's been out in the news, the portable mortgage and the 50-year mortgage. What are your thoughts on that? What do you think? Is that, who would be interested in a 50-year mortgage? Is that someone who's never intending to live somewhere for long term? They just want to get in with a lower payment? Because 50 years is I did some math. I'm like, that means my 25-year-old son would need to buy now to have his house paid off when he's 75. I mean, like, that's a long time.
And actually, I haven't really had too many discussions around it. I just, whenever I first saw a couple of breakdowns of the amount of interest that you pay over that time period, I my take on it is maybe it could be useful for some, right? Mainly I think like maybe investors could be a good fit for products like this. But for me, it's just when you look at the interest as far as over time on the loan, I just I don't know. I don't know if it's the best thing to put an ordinary person, right, that I may work with every day that has a tight budget, that they may have lower income. It I wouldn't want to set up anyone for
Mm.
not being successful later down the line. So that's all I have to say really about that. I think it really is going to depend on the client if it could be beneficial for the client. But I think it's a product we really have to educate people on so they can see the impact over time as far as what can happen if they continue just to make minimal payments on a 50-year mortgage.
Yeah.
Tell me what you think, Stanley.
Well, man, I am inclined to agree with Keena. We got about 100 colleagues in our firm, and everybody. We have a conversation every Wednesday, and it's a boo boo idea. It is from a political standpoint. It is just fodder to make noise. Because think about it, we ran the numbers from a 30-year to a 50-year mortgage. The payment changes maybe. Let's say you did 400,000 more. I think the payment's like $250 different,
exactly.
right? But it takes double to pay it off. So it becomes a horrible idea. And think about this, at 50 years, the rate's probably going to be higher. We're pricing it based on it's a 30-year today. If it's a 50-year, the rate's going to be even higher.
Exactly.
And it's going to be making it even more contentious for someone to become a homeowner. And so I'm talking to one realtor, and she said, well, some people, right now they won't be able to buy a home. And maybe I says, well, I'm just saying, homeownership, we all want it, but it ain't for everybody.
Yeah.
Because you have to be buyer ready. And if the scenarios and times, and I'm not trying to be insensitive about it, I'm just simply saying is to her point, we don't want to set folks up for failure. We want to set them up for success. And all of a sudden, we're seeing now, sadly, foreclosure rates are beginning to rise, and that was not even a thing 5 years ago. And so so on 30-year mortgages, we're seeing that happen. So what do you think will transpire on a 15-year?
50.
So
Yeah.
my feelings and experience when I first heard it, and President Trump made mention of it, I said this is a horrible idea. And so today we're doing. It was around for just a short period of time, a 40-year interest only. Man, I think that thing didn't get no traction at all. So
Really?
that's kind of my thoughts about it. That's been my experience, my conversation with my other colleagues who are like, man, this thing's not going to find any traction ever since. So secondarily, regarding portable mortgages or portage mortgages, that is not a new thing. 10, 15 years ago. So the idea about a portable mortgage is one that you carry to a new house. So the idea has been around because Merrill Lynch, basically private wealth clients. Um, I want to buy a house for my son, and he doesn't have credit, income, or qualify. So what they do is they just pledged $500,000 of my money and bought him a mortgage, and got him one. And then he can do whatever he wants with it in that sense. But they have the collateral there, so the money's being held there. From a traditional standpoint, think of this way: mortgages are sold in the secondary marketplace. So I got a 30-year fixed, 3.25% interest rate, and close a loan, and it's being sold in a bundle and package. Then I buy a new house, and I want to take that 3.25% to the new house. How am I going to do that because they now have sold it and it's been bundled, it's been sold 4 or 5 times. Now they're going to have to go back and get it and transfer to new property. I'm telling you, the secondary market investors, they will not do that at all. So
Okay.
that is the sauce in the back is what's transpiring. It will only work, or the term only comes up, is when it's in a private wealth management, or it's in, because those folks are holding the mortgages right there. Chase is holding that $500,000 more because his client's got $5 million and the money being pledged. He'll gladly put it on a new mortgage, so long as he still has the collateral. No big deal. But whenever you're selling in the open marketplace, that becomes a very different animal there. So that's
Can I ask that, Fossey? So you mentioned that foreclosures on the rise, right? So we definitely, as an investor, we're watching that as well because it's open opportunity for investors. But as far as lending is concerned, how does that impact you all when foreclosures on the rise? Do you say, okay, like for Florida example, we know that they're on the rise. Or I think Florida and Texas are in the leads for the high foreclosure rate. Does that mean that you won't lend in those areas? Like, how does that impact your underwriting? Like, how foreclosure rate?
for us, we take that data, and for example, we're still doing financing in Florida. We've got a big branch, 2 branches in Florida, but now they cut it back, saying is to, instead of doing 90% financing, we only do it 80. So we're making the adjustments, and especially with the condominium market in Miami. Oh my God. Yeah, condos and all of the HOA dues that are rising and all the work that's being done in that regard, that we're doing it, but we're not cutting back, saying we're going to do 65, 70% loan to value. So that's how we're doing it to mitigate in that regard. So
Great.
and then Fort Myers used to be a great place now. Now today, the market overall, and then all of the foreclosure and the HOA condo issues and dues, it has become a problem, a serious problem.
Wow.
Yeah. Yeah. What about you, Keena? Have you guys impacted as well?
I haven't really seen too much of a difference on my end. I primarily focus on North Carolina and South Carolina local market, but yeah, we really haven't seen too much of an impact.
I think your markets are growing. Now, what about like I don't know. So if you, because so I'm assuming Stanley, you're national, right? So yeah, he's all over the place. So like for Baltimore, you heard about for example, Baltimore was faced, the city of Baltimore, with some crimes uh, for, uh, from some lenders, or they got appraisals that were overpriced, and then now those homes are being foreclosed upon. For an area that you lend in, or is that an area that you have high LT moat value, or low, so ever
It's fun, Debbie. It's funny you would say that because, well, like I said, we are a nationwide lender, North Point Bank. However, I, as the manager of the office in Charlotte, in order for me to do lending in Maryland, I have to take a annual continuing education class, an 8-hour class, because it is one of the states that require a brick and mortar. And so since we do it that way, I just recently took that class. Now, from a financing standpoint, we do. Maryland's a little funky in how they do things, and that has probably become uh, the due to the foreclosure issues. And I will say this, that I do loans all over the country. Um, Atlanta at one point in time, and I'm a little surprised about Maryland, but Atlanta was the kind of fraud capital of the world, as from a mortgage standpoint. And so folks are really, really cautious about appraisal values and that type of thing. And so as a result of Maryland and those issues in that sense, um, unfortunately, those foreclosures in North Point was not including any of those. Matter of fact, I remember early in the year when they had kind of put a moratorium, we didn't lend in Maryland for about maybe 2 months.
Oh wow.
And then we came back to do some financing there once the state kind of got things together in that regard.
I wanted to kind of transition over again or back into conversation around lending and the first time home buyer. And not even necessarily first time home buyer. I've even had, seasoned move up buyers, what we call them, two, three, second, third home. Student loans.
Yes.
How are you guys viewing student loans? Are I think if I remember, there's like you only count if somebody has, I don't know, 50,000, 100,000 in student loans, you only count some segment of that. Is that right? Or how you guys you talk through how you guys
I'm going to let Keena say so. The student loans are the devil.
Yeah, I mean, to that, or you got Barry. Student loans, whether you're making payments or not, And that's what a lot of my clients get hung up on. I'm not making a payment. It's 0 right now. It does not matter. We have to count something, right? So typically, on a student loan with conventional Fannie Mae, we have to count at least 1% of the loan balance, and that's divided into 12 months. And then Freddie, which we didn't mention who Freddie and Fannie are, but those are the big head honchos in the lending world of things that securitize mortgages, and they basically support the lenders. So they come up with a book of rules that lenders have to follow called guidelines, depending on what type of mortgage product is being used. It could be a Fannie or a Freddie set of guidelines the lender has to follow. Freddie Mac is a little more lenient. They'll allow you to count 0.5% of the student loan balance. So what happens a lot of the times, what I'm seeing is a lot of my clients that have student loans, again, they just don't understand how much weight that carries with your debt to income ratio, especially if they're not expecting us to look at calculating a payment at all, right? Because they're not making a payment. So sometimes student loans can be it could be a burden on some, right? Whenever we're looking at debt to income ratio. But just know that we do have to count something unless you're in an income-based repayment plan. And there's a document that you have that says that based on your income, you can pay X for this amount of time. We have to make sure that it's a length of time that we need, typically at least 12 months, but we need to make sure that it is reflecting the time that we need to approve you. And if not, then we would have to get that updated by whoever your student loan carrier is. But yeah, what would you like to add, Stanley, besides the devil?
I will say today that to your very point that people will say that, hey, I don't have to make any payments. That's irrelevant. That at some point you will make a payment. And so as a result of it, they have to calculate. And again, I believe the reason why, because I'm not sure, I think maybe about 5, 6 years ago is when at one point in time, if it had no balance, if it had no payments, they're maybe not counting it. But then today they says, no, FHA, we're going to count a half a point. So if the balance is 50 grand, you got to count 1/2% of the 500, 250 is a payment amount.
Yeah.
You have to count it in the qualifying debt ratio. Um, like you said. So it's one of those things whereby if I see it and if it has no balance, I'm going to count it. I'm going to automatically run it in my calculation because there's no other way of getting around it unless you're in a repayment plan that says your payment is $10 a month. I did do a loan that was that way. I think she was in med school and it was about 125,000, but she's paying like maybe $100 a month. Pamela, I've seen him at $250,000. So I seen a $400,000 law school student loan deal. So yeah, I've seen those. Yeah,
I've seen them too.
Wow, that's a burden. My son, who I mentioned earlier, I was trying to get him to purchase a home, and he just feels burdened. He was like, "This market, how am I going to buy a house? I mean, everything's so expensive." And so and it might be his generation. He's Gen Z, right? And so his generation, they might rather just rent. They're not necessarily. He wants to be mobile. He doesn't want to be necessarily locked into a mortgage. And so, but I was trying to get him to see it from a standpoint. We talked about investing in you live the unit and you rent the other one as a stream of income, but I wasn't able to convince him. And so I think a lot of first time home buyers and even people, again, move up buyers, everyone feels like the market is inflated. But, we don't know what the future holds. We don't know if things are going to quote unquote reconcile or the balloon will bust. What would you say? What would you guys say to buyers who are on the fence, who want to do it but they feel reluctant, or what advice?
I always like to tell people don't get discouraged, have a conversation first because sometimes may think that there's no way and there may be a way. You don't know what to expect. So again, there are things that you can do, just like we mentioned, if you had an income-based repayment plan, that's a viable option, right? Or if you're looking at consolidating your student loans, that can be an option, but make sure you're having the conversation to find out. Just don't count yourself out based on everybody else's experience and stories because Yeah, has the same experience, and not everyone's credit is the same or scenario is the same. So find out based on you and what you could qualify for, what that will look like for your journey.
And don't let your friend on social media tell you, right? That seriously, oh my God, you would not believe the misinformation. Well, I heard this one. I said, oh my God, what do I do for a living? And I use this as an example whenever I do home buy education classes. It says, I had a client, he's a doctor, optometrist. He says, hey, my coworker tells me that you can do X. I said, it's funny. I says, my coworker says that you only need one eye and you'll be permanently fine. My, the idiotic of that stuff. I said, your coworker in the mortgage business is a doctor. If he's a doctor, he doesn't know the mortgage business. Don't listen to him. So, uh, so is that whereby knowledge is power? Find out where you are. I know people are afraid sometimes. I don't know my credit. Okay, let's find out. Here's what you want to do is let's find out and give you a roadmap so you at least know what you can do. I can't climb Mount Everest, but there's a Sherpa who can guide me up and down the mountain. He's there for a reason. So that's
Right.
the thing is in terms as to people today. If someone says, I don't know if I qualify, my credit bag has too long, you don't know. Let's just find out. And then when you do find out, someone can give you a roadmap and say, Keena can say, do the following things, and 6 months from now, you'll be buyer ready.
Yeah.
That's the idea.
Yeah.
Yeah, I want to piggyback on. So being that there's this, I mean, there's like 600,000 unemployed workers between the government and the corporations, the large corporations. Have you guys seen a slowdown in mortgage applications, or is it pretty much the same?
I've actually seen a nice uptick in mortgage applications over the last few weeks, which is when you watch the news and you hear all of that, right? You're thinking, man, a lot of people always reach out to me, like my sphere, my friends and family. They're like, girl, I feel so awful. You must be really slow with everything going on at Con. And I'm like, oh no, I am busy. I just article today, Stanley, where it said there was an uptick in mortgage applications last week.
I mean, Saturday, Thanksgiving, I get 2 purchase loan applications. Friday, the day after Thanksgiving, I was working. I didn't mind it at all, but that is a result of folks who say, hey, listen, the rates are where I want to be. I want to buy them and close before the end of the year. So no, Debbie, it may be 600,000. And when you said that, it made me think of COVID. In 2020,
Yes.
30 million people were out of work for a short period of time.
Yeah.
30 million. But do you know that loan application went through the roof? More second home financing, owner occupied financing was done during that time frame.
So with that said, so in this, so I'm sure that's market dependent, right? Because I know the North Carolina, the Carolinas are pretty good in terms of, I think Carolinas is showing a boom in market. Like people are like, for some reason they're like buying up down there. People are gravitating to that space. I guess Stanley, since you're nationwide, do you see other areas? Well, we just talked about Florida, right? Do you see some areas or up versus some areas are down holistically relative to mortgage applications?
So the areas that were really booming, one more time, Phoenix, Arizona, I think Salt Lake City, Utah, and some other areas, now they're beginning to slow down, because there are big second home markets and folks are buying there, but then the market has changed some. So it's kind of all over in that sense. But if you look at, so the NBA puts out their top 10 list of areas to live at. The Carolinas is still in the top 10. Raleigh and Charlotte are still markets because affordability.
Yes.
It is the second largest financial market behind Wall Street. So there's still a lot of jobs moving here, still a lot of fun. Then, of course, tech, the medical industry. So think of it this way in terms of the word jobs, where Amazon is moving. Well, those suburbs, those areas of Georgia now, they're building big tech centers. Home sales are going through the roof there.
But another follow-on question, do you guys primarily deal with agency money versus private money? Because from what I understand, is there's different lending characteristics when you go private funding, like hedge funds versus public funding. Do you guys like which side of the fence are you on when it comes to your lending?
For us at North Point, so my client base is about 30 to 40% of my business is what we call Alt A, meaning that that business is not sold to family. Typically, it's going to be bank statement business, right? The bank statement DSCR, those you can't sell to Fannie Freddie. It's got a Fannie and Freddie FHA's got to be income documented and verified, right? So 60, 70% of my business might be that. The other 30, 40% is going to be home equity credit lines, where those are portfolio products. It's going to be investment. It's going to be bank statement driven. I did one for a client early April, $2.8 million loan on a $5 million duplex in South Park. But it was had to be bank statement. Can't do that. And besides, Fannie Freddie is not doing jumbo business, so there has to be your Citibanks and your Chases and those other lenders outside the marketplace.
And I was gonna say I'm a mortgage broker, so I work with a little mixed bag of everybody. So I can do a little bit of everything. But yeah, we have the different investors tied to the different loan options. So it just depends. It really depends.
So that's why you can basically create any kind of lending scenario because you have that breadth and of products that are
Right. We have so many different lenders that we work with, whether it's portfolio or your standard like box lender, or we have some non-QM. It really depends, but I can shop different options between the lenders that we work with because we have multiples.
A couple of things a statement that I want to make to kind of debunk. I think the perception out there is that because you guys aren't affiliated with maybe like a new construction home, that you can't lend. So someone who is wanting to buy a new construction property, you guys can still lend new construction even if they have their in-house mortgage person. You all still have you can still supersede, if so to speak, their lender and still partner with the buyer to finance their property. Is that correct?
Yes.
Okay.
I know with us, so as you know, certain builders have their own in-house lending.
Mm.
And what typically transpires from time, at least my experience is that I'll get a phone call that for some reason the customer no longer meets the criteria. Either the income is not what they initially thought it was. And once they do that, then they're calling me. And um, and it has worked out well in the sense that typically folks like Pamela will say the builder is still willing to give the concessions that they're going to be given because their folks can't do it. And this is me and Keena. Keena, I used to be a mortgage broker for about 15 years. I absolutely understand working with different lenders. And I tell folks, we are paid for the information between our ears. And there's a possibility we may have more info between our ears than they do. And so figure out scenarios and problems, solutions to help them figure it out that they may not have considered. And so the answer is yes. And then Pamela, the other idea is that if a customer is building from the ground up, I do construction finance and love doing it. When somebody has their own land, their own builder, and they want to build a home, then I do the construction financing for them, as well as if they want to purchase the land and have the builder to give them the estimates, we can do all of that at one time as well too.
So one of the questions that I had, so you will finance the land. So if I have land, if I have my eye on a piece of land, I don't necessarily have the builder yet, but I have my own piece of land. You'll finance the land for me, and okay. And then once I bring in my builder on, and they give me a price to build a home, then you wrap that all in. Is that right? So you walk us through how that process works.
So one or two scenarios. So if you see the land, you want to buy it now, but you're not ready to build for another 6 months, a year later, we can finance it, but you got to put 35% down today. And we'll finance it up to 650,000, up to 50 acres. So you can do that. I tell folks, it depends on you. But if you say, I got a purchase contract to buy this lot for $150,000, and then I got a general contractor to give me an estimate for $600,000 to build, now I can finance 750, 90 to 95% on 750. So it's better to do it once because you're not putting much cash down. But if you put down 35% now and then 6 months later, we'll give you the equity value appreciation in it, but you just had to front the initial 35% down to buy the land, to acquire it. And I have a client, he did that because he just wanted to make sure he got the lot. And then a year later, he came back and built.
So what if I own my land outright, but I need the construction loan? Can I use the equity and okay? So does that mean I still got to put down 35%, or how does that work? Because now I own the
No.
land.
So the land becomes the equity at that point in time. So let's say it's worth, for the sake of conversation, it's worth 150,000. You paid 100 for 6 months, a year ago, and now it's worth 150. that becomes your equity there. So that equity plus the build, we'll finance, we give you value or credit for it, and we'll finance up to 90%, and then of the appraised value. So it might, that depending on where you're building at, it might appraise for $1 million.
Right.
And we'll loan you all the money, and all you got to do, and it will probably include closing costs.
Now, is that an adjustable rate? Can we do an adjustable rate mortgage on that?
Also, today with us, we used to do, right before COVID, we used to do 30-year fixed on construction loan. Not today. We only do adjustables. We do a 5-year fixed. And here, the good part about that is, right, during the construction period on a construction loan, think of it like a credit card. They gave you a limit of $100,000. And the builder over the 12 months is going to tell you that I'm going to need money in periods of time. And so 3 months later, you only have to make an interest-only payment on the amount that's drawn down. You make an interest-only payment 6 months. He needed $100,000 for windows and doors. He needed $100,000 for X. He needed $100. So then that way the balance goes up and your interest payment goes up at that point in time. But prior to that, you're only going to make the payment. Now, here's the good part about it. During construction, you only make interest-only payments. At the end of it, then that's when you can convert it to a 30-year fix with no prepayment penalties, nothing like that, because the loans don't come that way. So at the end of the bill, you say, hey, I want to look at 30-year fixed rates today. I do them all the time. This is the conforming 30-year fixed rate. The customer qualifies, and we just modify it into 30-year fixed. We love doing that. So that's kind of almost like a one-time close, because you're just modifying it to 30-year fixed. You don't have to go get a new mortgage. But if rates have gone up, some folks will say, I'm going to stay with the 5-year.
Yeah, right.
That did happen a little bit, but now in this marketplace, and Pam, why am I thinking that we have a mutual client that bought in Wackazone?
We do.
We do, right? So they came, they're like, "Hey, man, listen, is this my rate?" I said, "No, this is your rate." So they got a really good rate, and they're in great shape. So yeah, I think I gave them something like a 4% rate, like a 7-year fixed. So yeah, they're in really good shape. So yeah, so if you don't want to refinance it, because the rates are 6.5%, 7%.
For investment properties, does that apply for an investment property? If somebody finds an investment property, they want to fix it up.
There's a lot. I get your call probably once every other day asking, can you do investment construction financing? We call it speculative financing. And typically only hard money lenders work in that space. I've got a client right now that he had the equity to in his home. He took the equity line and basically built a new house with it, investment property, and then he kind of worked it out. But yeah, you need cash, right? So you're the person for that. Yeah.
For assumable mortgages. So I have a low rate, right? And so if I want to put my house on the market, are assumable loans favorable?
So FHA and VA loans are assumable government loans. Conventional loans tend not to be.
Okay.
So as an example, let's say I got a VA loan, which we actually had a realtor, we marketed one earlier this year. The rate was 2% on her 30-year fix. But here's the rub or the catchy part about it is if she's had the home for a long period of time, what she did is that her 2% mortgage is on $100,000. But she's selling for $400,000. Where does the $300,000 come from? The $300,000 has got to be new money. And so then you got to get an equity line for $300,000. Their rate's going to be 8%. So we did the analysis. It was better for them to get a new mortgage and assume the $100,000 because the average weighted cost was higher than to get the second mortgage. So now, if I've got a FHA loan and I'm 90% in equity, I only got 10% equity in it, it probably makes a good idea to assume that mortgage because it's better than where you are now. If you're at 4.75 on a $400,000 balance and you're selling for $500,000, people might be able to come up with the cash to kind of do it that way. But when you're $100,000 to $500,000 or $100,000 to $300,000, that's a lot of gap to have to cover. So that's why it tends not to be most advantageous because of the spread. But it sounds good in theory. It sounds really good because if I got a VA loan with 2%, and someone says, I want to assume your mortgage, you can. But the balance is $200 and I'm selling for $500.
Right.
Unless
they got cash somewhere, they can.
Exactly. And that happens every now and then, you know. So, yeah.
Oh, that's a great question. I just want to thank you guys. You're so knowledgeable and you have so much expertise. And it's good to know that things are jumping in the Carolinas for you all. The money is flowing like it should be. And hopefully after this session, we can flow some more money down here.
Well, again, too, I want to thank Keena and Stanley for their time today. I think this was a really great, informative session. Hopefully, any of our new buyers or our seasoned buyers, they will walk away from this with a lot of great information. I think the main thing also I want to emphasize here is that if you're interested in buying a home, let's get you pre-qualified. Reach out to Keena, reach out to Stanley, get pre-qualified so we know how much you're approved for before we go house shopping. That's a really key factor before we get started in this process. Hopefully, you heard enough information about what type of loans are offered, FHA, VA, conventional, that you can now be informed of what type of loan that may be necessary for you to move forward. So again, thank you, Stanley. Thank you, Keena, for attending and sharing all the insight. I will have all of your information on our page so people know how to get in contact with you. I look forward to us connecting and continuing to do business. I always have minds for you guys. And again, have a great rest of your day. Anything else before we end for today's session?
Thank you, Pamela. Thank you, Debbie. Thank you, Kenny. It was a
thank
pleasure
you
to be a part of this. Thank you, Glenn, as well. So thank you very, very much. I appreciate it. Thank you.
Thank you so much.